A lot of people are wondering whether or not we're in a housing bubble and whether or not now is the right time to buy. In fact, one of my most popular videos is the buy now or wait topic. Well, today I'm going to address the bigger topic, not the topic of whether or not now is the right time to buy, but rather how do you time the real estate market in general so you get the best possible deal you can when you buy a home. Let's get moving. My name is Scott Wynn, and I am a licensed mortgage advisor with the Wynn and Egan team at Citywide Home Loans. If you want to buy a home in the next 12 months, then click that subscribe button and together we'll make it happen. Timing the market can literally save you thousands of dollars, if not tens or hundreds of thousands of dollars. So how do you time the market? Well, let's take a look. Ultimately, timing anything comes down to data. The first thing I looked at is seasonal timing of the real estate market. Do you get a better price at a particular time of the year? Well, the answer is yes. Sort of. So that's where I turned first, to take a look at real estate data over the last 10 years. I looked at the monthly FHFA Housing Price Index for purchases only. What you can see here from the data is that home prices generally trend upwards, but there is some seasonality. In fact, if you look between March and June of each year, the market really heats up and prices increase more rapidly compared to the rest of the year. But then it starts to cool in August through January. So buying between August and January is your best bet in terms of getting the best home price, right? Well, not exactly. All this is really showing us is that during that time period of August to January, prices just aren't increasing as quickly as they are throughout the rest of the year. Not that the home prices have decreased lower than they were earlier in the year. In fact, if we look over time, housing prices did not decrease year over year or even month over month, with one exception, and that exception is the seasonality between November and December sales. What we see is a very slight drop in home prices between November and December of each year if we look historically on average. So what do you think? Are you with me so far? If you think that this information is helpful, hit that thumbs up. It helps me reach more people interested in this topic. So why does this seasonality happen? Well, it's following when people want to move. See, kids are out of school during the summer, and it's a natural time to make a move, not only because of the kids, but also because the weather is nicer for making a move. And in the winter, people generally like to stay home, be home for the holidays, and to avoid making a move, which is why we see a general cool down, pun intended, during the winter. But what if we look over a longer period of time, more than just 10 years? Let's look back to 1991 until today. This will allow us to take a look at the 2008 housing bubble and what happened during this particular time period. As you can see, there is certainly a drop in home prices due to the bubble. We saw the first indication of home prices dropping in August of 2006, but then they bumped back up to a high in May of 2007. And after that, there was a steady decline until we hit a low in January of 2012. Ultimately, we fully recovered from the housing bubble in March of 2016. So I have to tell you a story. See, I bought a house in the middle of the housing bubble. In fact, I purchased in April of 2008. That's literally just a few months after the absolute peak of the market in May of 2007. It was horrible market timing, right? Especially considering prices and interest rates continued to drop month after month after month. If I had just delayed my home purchase a couple of years, I could have saved thousands of dollars. But I didn't. But what if we could have purchased at the all-time low in January of 2012? That was the best time to buy, right? When housing prices hit an all-time low? Well, not really, and here's why. See, we have to factor in something more than just home prices. We have to factor in interest rates as well. Rates in January of 2012 were at 3.91%, but they were dropping. So the best way to look at this price and interest rate combination would be to calculate a monthly payment based on those two factors. And that's exactly what I did. And what we can see is we actually hit a low in December of 2012. That's the point in time when the price and the interest rate combined resulted in the lowest monthly payment we saw during that bubble. So how do we time the market so we can get the lowest possible price at the lowest possible interest rate and get the best monthly payment we can, or at least close? Well, this is where things get very complicated. There are 5 major factors that really impact the real estate market and therefore home prices. So let's take a look at these. The first is demographics, large subsets of our population. Think of baby boomers or millennials being those subsets. See, when the baby boomers are looking to retire and maybe downsize their home, that's going to have an impact on real estate prices because there's going to be more homes available for people to buy. And millennials are another subset that may be looking to purchase their first home, and that will also flood the market with buyers. These demographic indicators are probably some of the easiest to recognize and plan for when making your home purchase. The next easiest indicator to recognize is probably government changes. When we get a new president or the control of the Senate changes, these can have impacts on tax policies or incentives to make home purchases. And so therefore, these can be somewhat easy to recognize and can impact real estate markets as well. But what about some of the more complicated factors? Let's look at the economy. Now, within the economy, there are lots of factors that are looked at, but there are certain ones that may have bigger impacts than others. GDP, unemployment, and consumer spending are three of the top indicators that play into real estate prices. Not necessarily easy to predict, but certainly easy to recognize any changes that are occurring. Same thing with our fourth factor, which is inventory. We're seeing an inventory shortage right now, but why did that happen? What prompted it? What created that inventory problem that we're faced with right now, where we have simply more buyers than we do have sellers? Well, it was a slow and steady change that occurred over time, and therefore it's fairly difficult to predict, but again, very easy to recognize. And last, and probably the most complicated and difficult to recognize and predict, are interest rates. See, interest rates are more volatile than any other factor. Similar to the stock market, it's incredibly difficult to predict what will happen with the stock market. And because interest rates and the stock market are so closely tied, take a look at this chart, which shows you the impact of market timing on the stock market. This chart shows just how costly timing the market can be in terms of S&P 500 returns. Let's just say that you invested money and just kept it there over a 20-year period of time. Fully invested, you would get an 8.19% rate of return. But if you missed just the best 5 days, that reduces down to 5.99%. And if you happen to miss the best 60 days, it reduces down to negative 5.76%. That's just simply missing 60 days out of 20 years. And the impact is substantial. Well, interest rate volatility and stock market volatility are very similar, which means you can expect somewhat similar responses within the interest rate market as we see with the S&P 500. So with those 5 market indicators in mind in terms of the impact it's going to have on real estate and timing the real estate market, let's look back at 2008. See, 2008 was not due to a demographic type situation. It wasn't because we had a flood of sellers or a flood of buyers because of a particular demographic group looking to buy or sell. Rather, it was based on the collapse of the subprime mortgage market and, at the same time, the tightening of mortgage credit rules. And at the same time, inventory levels were at record highs. Speculative home buyers were bailing on contracts. Construction was at all-time highs, and foreclosures started to come on the market, leading us into that spiraling decline of home prices that ultimately led to a bottoming out in 2012. But at the time, GDP looked good. Unemployment was super low, and consumer spending was pretty typical. So who would have predicted the housing bubble? Well, there was one very smart guy by the name of Michael Burry. He's a neurologist by profession and the founder of the Scion Fund. Due to predicting the 2008 housing bubble, he was able to make over $100 million and over $700 million for his clients. In fact, he was portrayed by Christian Bale in the Big Short movie that dramatizes the 2008 housing bubble.
How big's your short position right now? Just 1.3 billion.
There may have been others that had accurately predicted the housing bubble and the collapse of the housing market, but not many publicly claimed such a prediction. And that's likely because they had a lack of confidence that that is actually what was going to occur. So let me ask you this. Did you predict the impact of the economy due to September 11th or the 2008 housing bubble or COVID-19? My guess is probably not. I know I certainly didn't. So how do we time the market? Well, let me return back to the story I had shared with you about the home that I purchased at almost the peak of the market back in April of 2008. It was almost the worst time to buy between housing prices and interest rates. So was I upset that I had made that home purchase knowing what had happened to the market? Not at all. In fact, it paid off pretty darn well. And that's because I didn't sell. I held on, and I held on tight, not only to that one property, but I had 3 rental properties at the same time. Now, it was challenging for sure. My wife and I did anything and everything we could to stay afloat, to make sure that we could make our monthly payment. We were still employed and earning the income we had earned prior to the drop of housing prices. So as far as the ability to make the monthly payment, it really had no impact. Now, the rental properties were a different situation. We did have certain months where we had vacancies and had to make that monthly payment without the rental income coming in. And ultimately, the housing market recovered by March of 2016. And coincidentally, we sold in April of 2016 and made a fairly decent profit. Could we have made more if we had waited a couple of years to buy that home? Sure. But I had no idea what the market was going to do, that housing prices were going to decrease, that interest rates were going to continue to drop, and ultimately it was the right time for us to make a home purchase. And that is exactly my advice to you. If you are looking to make a primary residence home purchase, make the home purchase when it's the right time for you. Because you need more space, or you need less space, or because the kids are getting ready to start school and you want to be in a different school district, or because of a job change. And do it when you can afford to do so, between paying the down payment, the closing costs, and the ongoing monthly payment. Not because you think interest rates are at all-time lows or that we've hit a bottom in real estate prices. And certainly don't stop from making a home purchase because of fears associated with a housing bubble. As you can see, back to 1991 through now, there's only been one situation during that entire time frame where a housing bubble occurred, and it recovered fairly quickly. If you wait to buy because of a housing bubble that doesn't actually end up happening, you could really miss out on tens, if not hundreds of thousands of home appreciation during that time period. And if you can plan to stay put in the home that you buy for at least 5 years, that in almost every situation will allow you to ride out any drops in the market that might happen. And if that drop doesn't happen, you'll be in even better shape.